You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. Since 2021, high inflation and elevated political polarization have contributed to some of the worst consumer sentiment on record, but the economy has so far managed to avoid a recession. The uniqueness of the post-pandemic economy has thus changed the ways consumer surveys are predictive of future economic behavior. On today's episode, we talk with Joanne Hsu, Director of the Surveys of Consumers at the Institute for Social Research at the University of Michigan, about how the economy has persevered through years of pessimism, ensuring the U Mich survey is representative of the American consumer, and why the survey is making her worry a recession could be just around the corner. Stay tuned. Coming up soon, our interview with Joanne Hsu, but first, a quick market update. The July jobs report last week showed payrolls grew by a modest 75,000 last month, but the real story was the massive downward revisions to the prior 2 months. Average monthly payrolls growth between May and July stands at a dismal 35,000. The Treasury curve bull steepened 20 to 25 basis points after the release, and traders went from pricing in 33 basis points of easing this year to 62 basis points. Fed officials have so far taken a relatively hawkish view of the report, focusing instead on the 4.2% unemployment rate. Their argument is that labor supply has fallen from stricter immigration enforcement, so it naturally follows that job growth will be lower. The low unemployment rate, they believe, suggests the labor market is still in balance. Those comments echo the post-FOMC press conference last week, where the Fed left rates unchanged without having seen the July jobs report. Fed Governors Chris Waller and Mickey Bowman dissented in favor of cutting rates by 25 basis points, the first two-governor dissent since 1993. As things stand today, the median FOMC participant is expressing much less urgency than the bond market when it comes to lowering the Fed funds rate. Also last week, the advance release of Q2 GDP showed 3% headline growth, a solid rebound from the 0.5% contraction in the first quarter. Tariff front-running has caused volatile swings in imports and inventories, so that 3% growth rate overstates underlying economic strength. Measures of private domestic demand are running just over 1% during the first half. Treasury also published its refunding announcement for the next 3 months of borrowing. As expected, coupon auction sizes will remain unchanged for the foreseeable future. The big news came from an expansion of the buyback program for treasuries maturing in 10 years or more. The program was set up to improve market liquidity, but the increased scope will effectively shorten the weighted average maturity for outstanding treasury debt, providing some downward pressure on long-term yields, but making federal debt service payments more sensitive to changes in short-term interest rates. Fed Governor Adriana Kugler resigned this week ahead of her term scheduled to end in January. President Trump will nominate a new governor that could potentially be his nominee for the next Fed chair when Powell's term ends next May. That's all for the market update this time. Now, our interview with Joanne Hsu. Our guest today is Joanne Hsu, Director of the Surveys of Consumers at the Institute for Social Research at the University of Michigan. Joanne, thanks for coming on the podcast.
My pleasure.
Our topic today is consumer sentiment, why it matters for financial markets and how its relationship with the economy has changed this cycle. Joanne, just to start things out, why do macroeconomists tend to think consumer sentiment is something important to follow?
Consumer sentiment is something that we've been measuring here at the University of Michigan since the 1940s, and we've been releasing it on a monthly basis since 1978. So we have a very long time series of data on consumer attitudes towards the economy, and particularly their expectations for the future of the economy. And over these decades of collecting data, a lot of research has shown that sentiment is an effective leading indicator for the macroeconomy. This shouldn't be that surprising because consumer spending is about 70% of GDP in the US. And so it is very clear that the fate of the economy is very tightly linked to the fate of the consumer. And there's just abundant amount of research that shows that when people are making saving and spending decisions now, they're taking into account their beliefs and expectations for where the economy is going in the future.
I think that intuition, you're correct, is pretty clear. If people are confident about their income prospects, their job security, they are going to spend and keep the economy afloat. But if they are nervous, then it leads to a paradox of thrift and aggregate demand in the economy goes down. So I think that's a helpful place to start. And just to reiterate, for those who don't know in our audience, that University of Michigan Sentiment Survey is really one of the most important sentiment surveys that economists look at. And something really useful about it is that it doesn't just ask thumbs up or thumbs down about the economy. There are tons of questions about current conditions and expectations for very specific aspects of household finances. Joanne, talk to us a bit about the mechanics of the survey. How many people are surveyed? What types of questions are asked? And how do you make sure the respondents are representative of the overall population?
That's a great question. So we're surveying a nationally representative sample, about over 1,000 consumers each month. So this isn't a survey of college students or anything like that. We're really covering the entire age spectrum, the entire income spectrum. We do miss Hawaii and Alaska because we're not confident that our mail gets there in time, but the lower 48 coterminous states in DC, we are well represented. And we send people invitations based on a random sample of postal addresses. And on that postal invitation, there's a QR code and URL where people can fill out the survey online. And doing this address-based sampling tells us exactly who is answering the survey and who's not answering the survey. And that gives us a lot of information that allows us to ensure that we continue to have a nationally representative sample.
Are response rates down for the U Mich survey? We've seen, especially after the onset of the pandemic, the surveys that the Bureau of Labor Statistics does for the jobs report, for the CPI, those response rates are lower, which to some extent lessens the statistical accuracy. Maybe people are not answering their phones because they think it's spam. They don't really want to divulge some information. So is there anything equivalent in the U Mich survey that you've seen in terms of lower response rates?
So the really special thing about the surveys of consumers being here at the University of Michigan at the Institute for Social Research is that surveys were born here. The Institute for Social Research was founded around the science of collecting survey data. So the top experts and professors around the world regarding survey methodology and survey science are right here. And I'm really proud to have them as my colleagues. And that has ensured that we are able to maintain data quality amid, an increasingly challenging data collection environment. It is absolutely true that people around the world are getting really saturated with invitations for surveys, and they may be less forthcoming about responding to surveys than they've been in the past. One of the benefits, again, of being here at U of M is that we are trusted. And because of the way we collect our surveys, we've been able to know exactly how our response patterns have changed over time or not changed over time. We're able to maintain the high quality of data. So even in a challenging environment, we've been able to maintain data quality, maintain the precision and reliability of our estimates. And I don't really think we'd be able to do that anywhere else.
Does the survey include any space for open-ended comments, or is it just a preset questionnaire? So if people wanted to explain why they have pessimism or optimism about a certain question, can they add that color, or is it just a preset questionnaire?
It is both. So we have a core questionnaire that's been asking a similar set of questions for decades, and that allows us to understand how consumer attitudes have changed. And as part of that core questionnaire, there are many places where we ask for open-ended responses. So as an example, when we ask people about their personal finances relative to a year ago, every person gets a follow-up question, and why is that? There are no answer choices that are involved with that. People can say whatever they want. And there are many opportunities for this. And that's one of the really special things about the University of Michigan survey is that we can capture these new concerns or new topics that are of interest to or that are important to consumers, which may not be relevant all the time. A key example is tariffs. So right now, consumer sentiment is relatively low. It had bumped up after the election, but then started plunging between January and May. And it might come as no surprise to your listeners, but our open-ended questions are loud and clear. The reason why consumer sentiment plunged during this period was because of concerns about trade policy. This most recent reading in July, we had 60% of consumers spontaneously offering unsolicited comments about tariffs or trade policy. It's pretty hard to get a majority of Americans to agree on anything. But on the survey for the last few months, we've had 60%, two-thirds of consumers wanting to talk about their thoughts about tariffs when, a year ago, no one was talking about tariffs.
That does seem a lot more accurate than if you say, if the question is, why are you pessimistic? And then the follow-up has three answers, tariffs, the weather, and traffic. There might be a little bit of bias in how people respond. I do want to get, though, into the details of the survey exactly. So we have the overall consumer sentiment index that is printed, and then you have an expectations component, a current conditions component, and lots of sub-questions. What goes into the index? How do you get, for example, when a print says 62? How do we interpret that?
The index of consumer sentiment, our headline index, is based on 5 questions. They are based both on current assessments as well as future expectations, on your personal finances, on business conditions, and buying conditions for durable goods. So it covers a number of different topics, both present and future. In addition to that, we also have a lot of questions on the survey that are followed closely by policymakers, including inflation expectations, where people believe changes in prices are going over the next year and over the next 5 to 10 years. And we have a wealth of other questions about different aspects of the economy, people's expectations over labor markets, their incomes, on stock market performance, on retirement security, on many different topics. But for the headline, it's based on the 3 topics: personal finances, business conditions, and durable goods. And we index, and higher index values means people are more optimistic. They feel more favorable about the economy. Lower numbers means they feel worse. And 100 is the number that we had in 1966. We indexed to 1966. During that year, the economy was really, really strong. So 100 is a very, very strong reading. In contrast, our historic low period was actually June of 2022, so pretty recently, when the post-pandemic inflation had hit a peak. During that month, the reading was 50. So 50 is extremely low, 100 is quite strong, and we're in the 60s right now. So better than 50, but still relatively dour.
That's helpful context because I know for surveys like the ISM's, the Institute for Supply Management, anything above 50 suggests expansion, anything below 50 suggests contraction. So really, what this index is that 100 is the conditions in 1966, which was a very good year. Can we compare the sentiment indexes with other readings from history? And I guess what I mean is it an apples to apples comparison to say, well, consumers were more pessimistic in June 2022 than they were at the height of the financial crisis or the onset of the pandemic? Or is it more helpful in a directional sense than looking at the numeric levels of the indexes?
I think it's most useful to look at our index values in terms of the trends, month to month, year to year trends. It's not necessarily that useful, I think, to compare now to 1966, 1982, pick your random year in history. And that's because society is just completely different. So as an example, when I was trying to understand why sentiment was so low in the post-pandemic inflationary period, one of the questions that we ask is about what news have you heard about the economy. And it turned out the share of consumers telling us that they heard negative news about inflation was much, much higher in 22 than it was in the 70s, when inflation was objectively much, much higher. But one of the big differences is in the 70s, you got your news once a day, watching the nightly news on TV, or once in the morning, reading the morning paper, and that was kind of about it. And whereas in the current environment, you might be looking at the news multiple times a day. You might be getting it from social media. You might be looking at it on your smartphone, on an app. The information environment is just completely different. So I think it's not necessarily meaningful to say, well, we are higher and lower than 40 years ago and say something about that. What's much more useful, I would say, is what is the trend that we're on right now? So right now, we've had 2 months of little movement after 4 or 5 months of plummeting of consumer sentiment. So we're not as bad as we were 2 months ago, but we're still well below where we were before the election. And I think that's the more meaningful comparison.
I think that idea of the salience of inflation news or maybe any bad news is a really interesting point of context comparing, again, the media cycle right now compared to the late 1970s. But digging a bit more into that, we have seen this dramatically lower sentiment through all of the post-pandemic economy and this ongoing pessimism, which, by the way, is in Gallup polls, other consumer confidence surveys, and tons of anecdotes, would normally point to a recession by now, but it hasn't happened yet. So do you think it is the weird variable of high inflation right now, or how people are consuming their news that helps explain this, or how do you reconcile these differences?
The first thing I would note is that these negative attitudes that you mentioned are not just towards the economy, it's towards lots of different things, towards the government, towards politics, about thoughts about polarization. We see that on a number of different dimensions. But on the economic front, it is true that after the pandemic, consumer sentiment was tanking and a recession did not actually happen. Usually, when sentiment declines that strongly, a recession follows soon thereafter. But I think it's important to note that the post-pandemic period, a lot of traditional indicators weren't really functioning properly or not functioning the way it has in the past. Yield curve inversions, the SOM rule, a lot of different traditional economic relationships just operated differently after the pandemic. And I think there is a pretty clear explanation for that when it comes to consumer sentiment. So consumer sentiment really fell quite strongly in 2022, and there's no mystery on why. It's because people hate inflation. They hate inflation. They hate high prices, and I think consumers as a whole had gotten used to this historically lengthy period before the pandemic of economic growth, stable prices, low interest rates, low unemployment. We haven't had that long and sustained of that kind of economic growth in a really long time. So I think consumers had gotten used to that. And so the inflation that we got after the pandemic was just extremely jarring, not to mention just the disruptiveness of the pandemic itself. But the other really unique feature about the post-pandemic period was that labor markets were historically strong. Unemployment rates were incredibly low. Anyone who wanted a job, by and large, could probably find one, and people did not fear layoffs. And in fact, a lot of people saw wage gains. And so in spite of the fact that they felt terrible about the economy due to inflation, they actually had the strong enough income to support continued robust spending. And so in contrast to previous periods, usually when sentiment is declining, confidence in their incomes are declining as well. And in this case, it really was this very unusual combination of high inflation and strong labor markets. And that brings me to the present period, where sentiment is relatively low right now, but unlike 3 years ago, consumers are showing weakening expectations for labor markets as well as their own incomes. We have almost 2/3 of consumers expecting unemployment to rise in the year ahead. And over the last couple of months, or through to April and May, consumers were expressing very high probabilities of suffering job loss in the next few years. And when we asked people about their income expectations, many of them were telling us that they were expecting weaker income growth. So the confidence in incomes that allowed people to spend despite low sentiment in 2022, that's just not the case anymore. I do think that there is reason to have caution about the consumer at this time. But again, it's not inevitable. We know this is being driven by trade policy and consumers' beliefs that trade policy is going to pass through to higher consumer prices. So if trade policy stabilizes, the consumer confidence could very well return.
I think that's a really interesting point about how the historical predictive power of this survey could go back to being strong if their income expectations do lead to a slowdown in spending like we did see in the past. But up until this point, are there certain components that you have found are still predictive this cycle, even if the relationship between pessimism and personal spending is weaker than it was before the pandemic? Of all those questions and all those different components in the survey, is there one that you can look at and say, yep, this is just as reliable as it was before the pandemic?
There are a lot of measures on the survey that are correlating very, very closely with consumer behavior now. So as an example, right after the election, we had a surge in consumers telling us that now is a good time to buy big ticket items to get ahead of tariffs. And indeed, Q4 2024 data on vehicle sales and durable goods sales were incredibly robust. And likewise, we saw in Q1 of 2025 weakening consumer spending. And again, that is completely consistent with the declining sentiment that we were seeing in the beginning of this year. So we are very much seeing consumers putting their money where their mouth is.
That index, actually, buying conditions for vehicles, that index in the survey. So before tariffs really started to distort everyone's perceptions of the economy, a lot of this data, a lot of spending trends, buying conditions for vehicles has been very low for a while, but people still bought cars the last few years. And I can see why people are frustrated by higher prices and higher interest rates. It really has been a bad time to buy a car. At the same time, people had to start going back to work after a pandemic shutdown. So this mentality of, I wish things were cheaper, but I still need to live my life. Is that a microcosm of the divergence we've seen between sentiment and economic activity over the last few years?
I think that is part of what was going on after the pandemic. And that is actually a comment that we see a lot in the open-ended questions, where when we ask people, is it a good time to buy vehicles, big time to buy big ticket durables, good time to buy a house? People are saying, no, but if you have to, you have to. Or you really should only buy those durables now if your dishwasher's broken. But if it's broken, you got to do what you got to do. And so there's an extent to which some of the spending that we might traditionally think of as discretionary spending isn't necessarily discretionary if the need comes up. And so that's one of the confusing things, I think, about when we're looking at spending in 2025, because we have a mix of people who are saying you should stock up now before the tariffs kick in, and then other people who believe it's probably too late. Like if you're trying to buy a car, it might take you a few months, and if you haven't already started, it's too late. So that's something that's in the data right now, kind of a balance between how people are conceptualizing the timing. But overall, consumers are expecting inflation to come back. That's something that's weighing down on their attitudes, and time will tell if their concerns come to fruition.
Something you brought up about people's media diets and all of that. Another explanation I sometimes hear is that partisanship has gone up. So this political toxicity weighs on people's view of the world, but doesn't necessarily impact how they spend and borrow. And I believe if you break out current conditions and expectations by party affiliation, there are these huge gaps right before and after the election. And you've got to think, okay, that's not totally logical. If you identify with one political party, your economic situation is really all that different, November 2nd compared to November 10th. Do you see anything in the University of Michigan survey that suggests widening partisanship? Has this always been the case and it cancels itself out? Or is it really showing up more in the survey than it used to?
We've been collecting political party intermittently since the 80s and on a monthly basis since 2017. And what's very clear is that partisan differences in sentiment, where people who share the same party as the president have more favorable views than if you're not the same party as the president, that's been the case since at least the Reagan administration. This is nothing new. It is true that polarization and partisan gaps have grown, but they haven't really grown that much since 2017. It was definitely larger under the first Trump administration than the Obama administration, but since that first Trump administration, that partisan gap has been pretty stable. The thing to note, if you look within political party, aside from presidential transition periods, they tend to move together. So this January to May, April, May decline in expectations, you see that even among Republicans. So even Republicans who feel like, who might broadly be in agreement with the president's policies, even they felt like the outlook for the economy was souring over the course of the beginning of the year. Even if they feel that tariffs might be good for the economy in the long run, they still felt like it might lead to some short-term pain. But I would also note that this isn't just partisan flag waving. There's actually quite a bit of research that shows that there are partisan differences in economic behavior as well. If you look at consumer spending, Democrats tend to spend more under a Democratic president. Republicans tend to spend more under a Republican president, and those things flip when there's a change in the White House. Likewise, Democrats are more likely to apply for patents, patent new inventions, or to start small businesses under a Democratic president, and vice versa for Republicans. And we even see that for tax evasion, these partisan differences that flip when there's a change in the White House. So even though it might seem weird that people on different parts of the political spectrum have such different views of the economy, it actually translates through to behavior. And at the end of the day, our national indices, our national measures are exactly the same as if we only looked at independents. That's even the case even during a presidential transition period, like between November and January. So Independents are very much, they're the ones in the middle. They're less swayed by political winds. And again, you might have Republicans and Democrats rotating around independents when the White House changes hands, but they're all three groups are still broadly moving in the same way.
That's really interesting. I suppose if one party's voters decides to ramp up their economic activity when if the president in power it belongs to their party, then there's a mirror effect on the other side, and so they seem to cancel each other out.
That's exactly right. They offset. Yeah.
In that way, increased partisanship it just zeroes out, and it's as if everyone agreed with each other anyway.
In the aggregate. Clearly,
yes,
people
right.
disagree on a micro level, but that's the incredible thing, that on the aggregate, all three groups are moving together. They're responding to the same developments. One might feel better than the other, but everyone's worried about high prices and inflation, and that's something that's common across the political spectrum.
Going back to the inflation expectations part of the survey, I consider myself someone who thinks about inflation a lot more than the average person. I also have to admit that if I had to give an estimate for how prices have changed in my own consumer basket over the last year or previous year, I would struggle to come up with a number. I know investors focus on the inflation expectations component from the U Mich survey past the decimal point. But how good of a grasp do you think the people surveyed have on projecting inflation either 1 year ahead or 5 to 10 years ahead?
If you randomly select a single respondent, you're not necessarily going to get something meaningful. But what's really special about the science of collecting surveys is that when you aggregate the entire national sample together and you take the median, the movement of the median over time has been shown to be highly correlated with CPI. It moves in the way that you expect, and it is a meaningful measure for the future. So it is true that for an individual person, this is going to be really challenging to answer, but aggregating them all together, it manages to yield something meaningful and informative.
You talked about how certain things this day and age matter a little bit more to the survey than they did in the 1970s, and that's why, for example, inflation is weighing on people more than it was when inflation was much more persistent and even higher. If the survey is best designed for, let's say, pre-pandemic economic conditions, is there ever consideration to change the weightings of some of these indexes to reflect, for example, how much people hate inflation? Or is that really not the point? It's just indexed to 1966 and you want to leave it put so we kind of have a statistical consistency?
The integrity of the time series data is a top priority for us because when people look at our data, they're often trying to use the trends in the data to try to identify possible inflection points in the economy. You don't need a survey to tell you, are things strong right now, or what did things look like a year ago? A lot of the hard data that people talk about is backwards looking. We're not trying to do that. We're trying to give a window into possible turning points in the economy. And so as such, from a month-to-month, year-to-year basis, we want to be as consistent as possible, and that's a major priority of ours. And so for the index of consumer sentiment, we've been using the same questions over time. And, those questions were selected after a lengthy amount of experimentation and research. At the same time, we're constantly innovating as well, in the sense of we're always looking for ways to make sure that we are collecting high quality data, even in a challenging environment. And we add questions and additional questions all the time. We periodically ask questions about whether people have trust in the Federal Reserve or other financial institutions. We don't ask that every month, but we're going to be adding that because it seems to be relevant with current events right now. And we have added and subtracted questions in accordance with recent developments. The political party question was one that was not asked consistently until 2017, but it appeared to, partisanship appeared to be something that was really important in telling the story. And now we collect it every month. We're always looking at longevity. We want to put out data that's useful to our data users. And at the same time, we want a consistent time series that people can trust. And so we're always balancing the two.
I think you mentioned previously one thing that is giving you concern about consumers' job or income security that you think could lead to a significant pullback in consumer spending. So I want to end on that topic because the next recession has famously been 6 months away for a few years now. What do you think is really pointing to an inflection point coming very soon? Kind of the idea that all of these indicators, all those rules, the SOM rule, the inverted yield curve, everything, they've had false signals so far, but this time it really could be different, and there's something in the survey that is making you think, well, a recession could be very close.
I think signs of a potential economic slowdown are flashing quite strongly on our survey. And it's specifically, I'm pointing to those labor market and income expectations questions, because that is the one thing that really differentiates the current moment from 3 years ago when inflation was quite high and sentiment was quite low. At that time, we had consumers spending being supported by strong incomes, but now confidence in incomes has really plummeted. Consumers are very, very worried that tariff hikes or volatility in tariff policy are going to lead to a deterioration in business conditions, and not only just business conditions, but that it's going to weaken labor markets and their own incomes as well. And if you're not confident in your own income, you're not going to be willing to take financial risks. You're not going to be willing to spend. You're going to pull back. You're going to try to protect yourself. That is really primary reason why I'm looking out for these warning signs, and I hope people look at them too. At the same time, it's not inevitable. It could be that tariff policy stabilizes in the short run. It could be that tariff policy stabilizes soon. If that's the case, if certain high tariffs are taken off the table or agreements are signed that stabilize tariffs for the next few years, I think consumer confidence could return. But as long as we're in this sort of limbo of we might have really high tariffs, or we might have medium tariffs, we really have no idea, it's hard to see how confidence can be restored.
Joanne Hsu, thanks for coming on the podcast.
It's my pleasure. Thanks for having me.
That was Joanne Hsu, Director of the Surveys of Consumers at the Institute for Social Research at the University of Michigan. It's helpful to know how sentiment surveys are still predictive this cycle, even when the headline index has been consistently negative. Labor market sentiment and people's awareness of government policies, for example, have been good leading indicators of future economic behavior. I also think it's useful to know that the movements of the indices within each business cycle are more informative than comparing the numbers across the entire history of the survey. The July CPI will be released next Tuesday, the latest data showing the extent that tariffs have passed through to consumer inflation. A soft reading in the core index would further support the argument that tariffs pose a benign risk to future price increases. The PPI on Thursday will help complete the picture. Also next Thursday, July retail sales will be the first big input for third quarter personal spending. Fed Chair Jerome Powell will be speaking at the annual Jackson Hole Symposium in 2 weeks. Historically, the Fed Chair can use the opportunity to signal a pivot in near-term policy or bigger picture thinking. The title of the event is Labor Markets in Transition, Demographics, Productivity, and Macroeconomic Policy. There are several other Fed officials scheduled to speak over the next 2 weeks, all on the calendar for after the CPI release. It's possible some FOMC participants will change their perspective on the Fed's balance of risks once the July inflation data are released. On August 20th, the Fed will release the minutes of its July meeting, which should be more interesting than usual to read, given the 2 governor dissents against the decision to leave rates unchanged. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.